Hello, time for another market update. In this video, I'll go over silver, gold, the ratio, crude oil, the stock market, a lot of stuff that's going on because we're seeing major retracements within the indices and oil and pretty much everything but gold and silver. Although silver definitely joined the party today, it is still in somewhat of a bullish case in here. It's really extremely cautiously bullish at this time and we're seeing how a lot of big moves are occurring. And if you're used to what happened in 2008, when there was a lot of capitulation and a lot of wild volatility, then you'll be ready for situations like this where stock markets will move 200 points in 10 minutes and the silver market moves 3%, 4% in 4 minutes, as these moves are very common when the markets are in this type of mode, because in unvolatile markets you'll see situations where silver will go down 20 cents and then up 15 cents. Now it goes down 70 cents and up 40 cents. The steps up and down go bigger with volatile markets, and the volatility, it comes and goes. We haven't had the major volatility yet that we're expecting. I don't think this will be the start of it anytime soon, but it very easily could be. You don't know exactly when the big things are going to be coming into play. Now, as far as this market's concerned, we got this big Fibonacci level here, and within this level, we can see here it says 38.15, and it's the 61.8. Now, before the 38 was the level here, then there was another one up here. Well, what happens is when you hit this level and you come back, or as long and that's your top, that is, then the Fibonacci from the same low and the new high will always match up in here. So that's giving 38.15 a lot of emphasis. Now, just because you're there doesn't mean that it's going to hold. That isn't that big of a gain from here to here. Therefore, when that's the case and you come back here, oftentimes it may not hold, or even come up, have a rally maybe up to the 40 area, 39.75, and then it doesn't hold, and then you got this significant level, which would be 35.82. So that would be the significant level. Now, as far as the quantitative easing is concerned, I wanted to say this on the intro, but I'm going to say it now so I don't forget. When you see the debt ceiling being raised as it is, then that should assure you that it's been done. It's been signed by the president himself, and this has been going on for hundreds of years, about 100 years, that is. And that's why the national debt is so big. And by adding more debt, they're solving the debt crisis by adding debt. That's their simple solution to the problem. You don't have to laugh at them. Maybe they'll figure it out. Anyway, we see in this that gold did the best. We'll move to the gold chart. It's still riding very nicely above this 18 period average and still well above the highest point where silver went below here. So that's showing gold's been doing much better. The gold high is set at 1685, and at 5 o'clock today, it was only $40 away from it, meaning it's only 2% from its highs that it just put in, showing big strength within the precious metals. And because gold's only lost a couple percent from its highs and silver lost many percent today, that's made the ratio come up and make this big level in here. And you can see this Fibonacci level has been very big as well. This level is at about 40 and a fifth. And it's been finding support here. The market had this 18 period average come to it through time. So original the price correction was through, or the correction was a price one, and then it did that through time, and it's now breaking out towards the upside. It still really needs to get above this resistance. And when you recalculate Fibonacci, now you look from this number to this number, which should be somewhere in here. So now what's the question? If this comes back down from this resistance, then that increases the chances of breaking it out. Maybe it finds a higher low in here, then it increases the chance of breaking to the upside, say it does, and then you want to see it stabilize or do something to confirm that this is a failed move, because either this will be a failed move or what's the other one? The move from 60 all the way down would be that of a failed move, of course. Alrighty, so I'm done with the rate. Actually, I'm not done with the ratio. If we take a look at the long-term look at the ratio, we can see within here that The market really does have a long way to go because you got to calculate the Fibonacci from this high to this low, and it really needs to get above somewhere in here for this move to be that of a failed move. As far as crude oil today, it took a big pounding as it went right down towards this band. And this is a band similar to a Bollinger Band. However, it does work within this average above, the 18-period average, so for the most part, will trade within it, but it does recognize what the volatility for the market is. When the volatility gets big, these bands expand. That's why we're seeing this go up and this go down. That's the way the markets expand. And when the volatility goes low, then they move in together, but not as aggressively as the Bollinger Bands would. Because when you're in a range, a lot of times the bands will be just right above and below it. Myself, I don't think I need bands above and below the different ranges. So I like the way this one is set up. It's a very simple calculation for the most part, but it does the trick very well. Overall, though, the markets have been selling off big, and we look at this 86 level that we have for oil. We'll bring up a trusty little calculator, and we'll take the high of oil a long time ago in 2008, which is around 147, divided by the lows, and it got down to about 32. Put this to the power of 61.8%. And then we'll multiply this by the low. That's not going to work because I didn't put the right information. And let's try it again. 147 divided by 32 to the power of 61.8%. And multiply this by 32. That gives us a price objective to 82.10. Now we've already had the confirmation break above it. I talked about that many months ago. And it's had an okay run above, but it hasn't made new highs, and now it's back to that area. So this is going to be a very massive level, an area where normally it would find support. But if it doesn't, and it has a decent break below it, then that is one heck of a major failed move to confirm that you're going to get above 81, to get upwards to around, what did it get up to, like 120, or even 110? And then to end up failing within it, then that's pretty big. Now, I think most likely that area would hold, or it would create another fast move, maybe going down below 60. But this is tough to say, because every single time we've had these big moves, we always end up finding bottoms within the markets. And now we have the Dow Jones doing the same thing. It's below its Bollinger Band, or it's not a Bollinger Band, but below the lower band. Doesn't happen too often. However, the last so many times, like the flash crash, and a lot of them have ended up failing. And that's always going to be the case when things aren't so bad. It's difficult to assume if this is going to be the start of things getting really bad. And when we have a band like this, what I like about this is this tells me more about parabolic moves, because when a situation on the upper band, it goes above it and has big gains above it, or anything like that, that's parabolic. Well, the opposite's true. When you have the big plays below it for several turns, several candles, then you're having crash-like symptoms, because normally when markets crash, there are indicators before telling you it to be the case. We're now at the point where that can happen. We could very easily have a 1,200, 1,000-point down day, although it's extremely unlikely to occur, but they seem to happen a lot more when it breaks these types of lines and the volatility increases to big levels. I don't know what the chances are. They're not good, but they're more possible. When the silver market crashed back in May, it wasn't within that type of indicator. Normally when markets crash, it's because of these types of declining situations. And I'll finish this up with the direction from the 50-day average. We still have the bullish line above the bearish line. Therefore, the bulls are still in control. Now, what would be ideal is for them to come up and match together, and then for the lines to reverse again back out like that. That would be ideal. Sort of like in here where they match together. And I've seen on other charts it does the same sort of thing. It's somewhat common, but again, this could be telling us we're going into neutrality. My overall bias with the fundamentals is that the market is going to be going higher. Thus, it wouldn't be a surprise if something like that were to be the case. But again, you want to always adjust to what the message of the market is, because nobody really knows exactly how each tick and each day by day movement is going to come with. But anytime you see how your expectations can change on the market, it's probably best to reevaluate things and see what the message of the market is now saying. Thanks for watching and take care.